Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the complicated world of corporate finance. And today we are diving deep into FormFactor's latest annual report, which is packed with enough numbers to make your head spin. But don't worry, we'll break it down into bite-sized pieces. Alright, let's get straight into it. FormFactor has just released their annual report for the fiscal year ending the 27th of December 2025, and it is a big one detailing their financial health and business performance. This report is essentially a yearly checkup for the company, giving us a full picture of how they've been doing. So what is the headline here? Well, FormFactor managed to hit a record high in revenue for 2025, raking in an impressive $785 million. That is a solid number and shows that despite a tricky market, they're growing. Now, if we look at the revenue itself, it came in at $784.993 million. That is a slight increase from the previous year, which was around $763.599 million. This growth is good, but it is important to see where it is coming from. A big contributor to this revenue growth seems to be their DRAM products, which saw a significant jump from about $227 million in 2024 to $247 million in 2025. This is particularly driven by demand for high bandwidth memory chips, which are crucial for those fancy new AI applications we're all hearing so much about. So FormFactor is clearly benefiting from the AI boom. However, not all segments are booming. Their foundry and logic product revenue actually saw a small dip from $381 million in 2024 down to around $370 million in 2025. The report mentions this is mainly due to weaker demand for probe cards used in PC and server processors. Basically, fewer chips being made for those specific areas means less demand for FormFactor's products there. Looking at where the money is coming from geographically, South Korea has become their top market, representing about 30.3% of revenues in 2025. This is a significant increase from previous years, showing a strong shift in their customer base or demand patterns. Now let's talk about profitability. Their gross profit for 2025 was $308.851 million, which is pretty much flat compared to the previous year. However, their gross margin, which is gross profit as a percentage of revenue, actually decreased slightly from 40.3% in 24 to 39.3% in 2025. This means that while they're making more money overall, it is costing them proportionally more to make their products. The report points to increased manufacturing costs and tariffs as a key reason for this. So even with record revenue, their profit margins are a bit squeezed. On the innovation front, they spent about $115.6 million on research and development in 2025. That is a slight decrease from the previous year. While it's still a significant investment, it is worth noting if they're cutting back on creating the next big thing, especially in such a fast-moving tech industry. Their selling general and administrative expenses also saw a decrease, coming in at $133 million compared to over $141 million in 2024. This suggests they're trying to tighten their belts and control their overhead, which could be a good sign for efficiency, but also sometimes means less investment in sales and marketing. A notable new item this year is factory startup costs, totaling over $3 million. This is tied to their new manufacturing site in Farmers Branch, Texas, which they purchased in June 2025. They expect significant costs here in the coming year as they ramp up production. This is a big investment in their future capacity. When we look at their cash position, it decreased to about $107 million at the end of 2025, down from over $197 million at the end of 2024. This drop is largely due to significant spending on their new Texas facility, their equity investment in FICT, and the acquisition of Keystone Photonics. While a lower cash balance can sometimes be a concern, it is important to see if it is being used for strategic growth, which it appears to be here. On the debt front, they entered into a new $150 million revolving credit facility in July 2025. Good news, they had no amounts outstanding under this facility as of the 27th of December 2025, meaning they weren't borrowing money unnecessarily. Now, let's touch on goodwill, which is what a company pays for an acquisition above the fair value of its assets. For FormFactor, goodwill increased from $199 million in 2024 to $216 million in 2025. This rise is mainly due to their acquisition of Keystone Photonics, which shows they are actively buying companies to grow their business. Their intangible assets like developed technologies and trade names remain substantial, totaling over $16 million net in 2025. This is a testament to their intellectual property and the value of their technology. Looking at the overall balance sheet, their total assets grew to over $1.2 billion in 2025. This increase is driven by property, plant, and equipment, goodwill, and that new equity investment reflecting their expansion and strategic moves. On the other side, total liabilities are around $189 million. This is a managed level, and importantly, their total stockholders' equity, which represents the owner's stake in the company, stands at over $1 billion. This is a healthy position. Moving to the bottom line, net income for 2025 was $54.4 million, a decrease from $69.6 million in 2024. The report explains this is largely because a significant gain on the sale of their China operations in 2024 didn't repeat in 2025. So, when you remove that one-time event, their core operations are performing reasonably well. A new line item here is the loss from equity investment, amounting to $2 million in 2025. This relates to their investment in FICT Limited. It is not a huge amount in the grand scheme of things, but shows they are diversifying their investments beyond just their core business. Their provision for income taxes was about $13 million in 2025, leading to an effective tax rate of 18.7%. This is higher than the previous year's rate of 12.3%, partly due to changes in tax laws like the One Big Beautiful Bill Act. Now, no corporate report is complete without a discussion of risks. FormFactor points out intense competition, product demand fluctuations, reliance on a few key customers, and the cyclical nature of the semiconductor industry. They also highlight geopolitical risks, particularly between the US and China, and the evolving data regulations there. Basically, they're exposed to the ups and downs of the global tech market, which is inherent in this industry. They also have a pretty detailed section on cybersecurity, emphasizing their commitment to managing risks, integrating it into their overall risk management, and training employees. Thankfully, they report no material cybersecurity incidents. Their property section shows a real estate footprint across the US and Germany, including their headquarters in Livermore, California. They've also purchased that new manufacturing site in Texas, indicating a move to secure more domestic facilities. Looking at the management's discussion, they are clearly focused on diversifying their customer base and benefiting from AI-related infrastructure, but they also acknowledge a dip in gross margins due to manufacturing costs and tariffs. This is where you see the real story behind the numbers. They're growing in some areas like Dockram for AI, but facing headwinds in others like PC and server chips and rising costs. Finally, a quick look at their stock performance compared to the S&P 500 and the semiconductor index. Over the last 5 years, FormFactor's stock has shown solid growth, outperforming the S&P 500 in the last year and showing strong cumulative returns overall. This suggests investor confidence, despite some of the market and operational challenges outlined in the report. So, what is the verdict? FormFactor is a growing company that is successfully tapping into the AI trend with its DRAM products. They're making strategic investments in new facilities and acquisitions. However, they're also navigating increased competition, rising costs, and the inherent cyclicality of the semiconductor market. The dip in gross margins is a concern that investors will be watching closely, and their ability to manage those rising costs and tariffs will be key. But overall, the company seems to be steering through a complex landscape with a clear strategy for future growth. What do you think about FormFactor's performance? Are you bullish or bearish on their future prospects? Let me know your thoughts in the comments below. If you found this deep dive valuable, please hit that like button and subscribe for more corporate breakdowns. And don't forget, we have a great community on Discord discussing these topics, linked in the description. Thanks for watching, and I'll see you in the next one.